Here's a statement that truly grabbed our attention. Just a little preview of what we're about to unpack today. Audio clip. Quote, "Nothing stops this train now. The U.S. is kind of locked into pretty high structural fiscal deficits going forward, especially on the spending side. The cycle is certainly led by institutions, not really retail." That's a bold statement, isn't it? And maybe a little unsettling. Nothing stops this train now. Get ready, because we're going to really understand what that means for the economy, for markets, and, yep, most importantly, for your investments, for your financial future. Welcome to the Deep Dive. This is the show where we meticulously sift through, well, frankly, stacks of expert sources, articles, research, you name it, and we pull out the most important nuggets of knowledge, the key insights, just for you. Today, we're plunging headfirst into the latest, and I have to say, incredibly insightful analysis from a highly respected expert in the, let's face it, complex world of macroeconomics and investment strategy. Our mission for this deep dive, it's simple, really. We want to equip you with a crystal clear, concise understanding of some seriously complex market dynamics. We'll look at the most effective investment approaches in today's unique environment and those powerful underlying forces that are, well, undeniably shaping our financial future, and we're getting all of this straight from the source material. We'll skip the jargon, okay? Our goal is clear, practical takeaways. We want you to feel truly well-informed by the end of this, maybe even surprisingly so.
Absolutely. And, this deep dive isn't just about rattling off facts or figures. Our aim is to illuminate not just what is happening out there in the global economy, but crucially, why it matters specifically to you. We'll be connecting what might seem like, separate, unconnected pieces of information, trying to reveal that broader interconnected picture, because this is about more than just knowledge, right? It's about encouraging your own critical thinking about your financial landscape and how these really monumental shifts could directly impact, well, your savings, your investments, your long-term security.
All right, let's unpack this fascinating perspective right from the start then. Our expert describes the current economic situation, well, a bit differently from the usual headlines we see everywhere. It's not really labeled doom and gloom, but rather as a malaise or, and I find this intriguing, a range-bound period. That's quite a nuanced way to put it. And it immediately makes me ask, what exactly does that mean for us, the everyday observer? In simple terms, how should we interpret this malaise?
Yeah, that's a great question. When the expert uses terms like malaise or range-bound period, it's suggesting we're not necessarily heading into some catastrophic downturn, right? But nor are we expecting a roaring boom. Instead, you could maybe imagine the economy like a car. It's capable of high speeds, usually, but right now it's driving along at a noticeably slower pace. Maybe a few minor engine issues slowing it down. It's definitely not breaking down, but it's certainly not sprinting either. It's in a phase of economic deceleration. Overall performance is likely to stay within a somewhat predictable, often kind of subdued range.
Okay, like it's jogging slowly on a treadmill, staying within a limited zone, not really going anywhere fast.
Precisely. That treadmill analogy worked well. You're moving forward, but staying within a contained zone, not covering vast distances quickly. And the crucial insight here, the thing that moves beyond just that overall feeling, is the expert's emphasis on sector-by-sector analysis. So instead of painting the entire economy with one broad brushstroke, they dissect it. They're meticulously looking at individual industries, trying to figure out if an industry is already priced for a recession, meaning, the market has already factored in the worst-case scenario for that specific sector versus if it's merely at risk of facing challenges down the road. This implies that while, yes, certain specific industries might indeed face significant headwinds, the overall economic picture remains subdued, but generally not catastrophic. It's a very nuanced view. It acknowledges there are real pockets of weakness, real challenges without declaring a full-blown systemic crisis is upon us. It helps you see where the stress points are and maybe where some resilience still exists.
Right, so it's about understanding the individual nuances of those different economic engines, like you said, rather than just looking at the whole car. Some cylinders might be misfiring, but the engine as a whole is still running, just not at peak performance. That level of detail is exactly why we do the deep dive. It avoids those broad strokes of recession, or boom, and focuses instead on where the actual risks and, importantly, opportunities might lie, which, as you point out, can vary dramatically from one industry to the next. Okay, that makes sense. Now let's pivot a bit from that big picture economic outlook to investment strategy itself. Our expert uses what's called a dual capital approach, and that sounds incredibly intriguing to me. Can you walk us through the two main pools of capital involved here? Maybe starting with the venture side, they call it ego death capital. What's behind that name and what's its focus?
Absolutely. So ego death capital, it operates on the venture side of the investment spectrum. And yeah, the name itself kind of hints at a focus on maybe fundamental shifts, perhaps a departure from conventional thinking. They've recently raised a significant amount, $100 million for their fund too, and their primary focus is leading Series A investment rounds that's typically early stage funding for companies. What's particularly distinctive about this fund, though, and what really sets it apart, is its very narrow and, I'd say, disciplined focus. Unlike many broader crypto or Web3 venture funds that have raised billions and cast a really wide net across tons of digital assets and protocols, EcoDev Capital concentrates almost exclusively on the Bitcoin space. They do allocate some capital to stablecoins as well, but critically, their investments are centered on applications within that Bitcoin ecosystem that are focused on high utility.
High utility meaning?
Meaning real-world practical uses, not just speculative plays, things that actually do something useful. The rationale here is that the expert perceives a significant yet currently kind of underserved market for these specific utility-focused areas within the private venture space, specifically around Bitcoin. They believe these foundational, practical applications within the Bitcoin ecosystem offer some of the strongest growth potential going forward, precisely because they're building essential infrastructure rather than just, chasing the latest hype cycle.
Okay, that's a very targeted approach then, almost surgical. Prioritizing utility within one specific segment. Makes sense. And then for the public side of their investment strategy, there's this distinct three-pillar portfolio strategy. What's the overarching philosophy or the big idea behind building a portfolio on these three specific pillars?
Right, the public side portfolio. It's designed as a very structured, deliberate approach for managing public investments, things like stocks and bonds you can buy on the open market. Its core aim is really to achieve a balance of both resilience, being able to withstand shocks and growth within the current complex economic environment we were just talking about, that malaise. It's built upon three distinct pillars, and each one serves a specific strategic purpose in navigating these nuanced market dynamics and the, frankly, inherent volatility we expect to see. It's not about finding the single best asset class, but rather creating a robust, diversified framework that can hopefully weather different conditions while still capturing some upside potential.
Okay, let's dive right into those pillars then, because this is where the really actionable insights for our listeners start to come alive. Starting with Pillar 1, high-quality equities both in the U.S. and globally. Where is the expert finding geographic focus right now? And what's the detailed strategy within U.S. equities? Is it broad market or more specific?
Okay, Pillar 1, equities. Geographically, the focus is quite interesting. The expert points to a potential wake-up call, if you will, in Latin American equities. The thinking is that they may finally be emerging from this long period of, perpetual underperformance against U.S. equities. It's been a tough ride for them for a while. Now, they caution it certainly won't be a straight line upward, nothing ever is, but there's a strong indication of a potential turning point, suggesting this region could be poised for a significant shift in investor perception and ultimately performance. Additionally, and this might surprise some listeners, the expert has maintained a fairly bullish stance on Chinese equities.
Really? Despite all the negative headlines?
Yeah, which for many is an interesting counter-narrative. Given some of the prevailing negative sentiment about that market, it really highlights a focus on underlying value and potential re-rating, rather than just reacting to short-term headlines.
Now, shifting to the U.S. equity strategy, the preference leans towards service sector stocks.
Why services specifically? Well, they're generally seen as more protected from the cyclicality of the broader economy. The ups and downs that often hit manufacturing or commodity-dependent sectors harder. And they're also generally more insulated from potential tariff impacts. Within this, the expert is particularly bullish on financials, banks, insurance companies, that sort of thing. These are considered relatively inexpensive compared to their earnings right now, and they're seen as relatively protected from significant downside scenarios, especially when you contrast them with some of the really highly valued, high-flying tech stocks that have had massive runs already. However, it's not a complete avoidance of tech, not at all. They also see opportunities in the Mag 7, the Magnificent 7 stocks.
Yes, the big names.
The big ones. But specifically for growth at a reasonable price. That last part is key. Emphasizing a balanced approach that seeks both value and growth opportunities, not growth at any cost. But, and this is a crucial caveat, while individual targeted opportunities absolutely exist, the expert believes the top line of the index is kind of stretched currently.
Meaning the overall market, like the S&P 500.
Exactly. The overall broad market index might not see significant across-the-board gains from here because, frankly, a lot of the good news might already be priced in. So individual stock picking, being selective, becomes even more critical in this environment.
Okay, so it's a strategy of highly specific area selection rather than just betting on the entire market to keep soaring. That definitely makes perfect sense in a range-bound or malaise kind of environment. Taking that idea further, let's explore the second pillar, hard monies. This includes Bitcoin, precious metals, and commodity producers. What's the short-term and long-term outlook for gold? And critically, why is Bitcoin prioritized in this strategy even over gold, which, let's face it, has millennia of history as a store of value?
All right, pillar two, hard monies. For gold, the near-term outlook has been somewhat cautious recently. The expert expressed concern about consolidation potential starting a few months prior, meaning they expected gold prices to basically trade sideways or maybe even pull back slightly after its strong run. And that consolidation was anticipated to continue for a bit longer. However, the long-term view, that remains firmly bullish, especially post-breakout from its previous range. Gold is recognized as a truly mature, massive asset class. We're talking around $20 trillion globally. That firmly signifies its established role as a traditional safe haven, a store of value in the financial system. Now, here's where the expert's perspective really distinguishes itself, and I think offers a profound insight for you listening. Bitcoin is prioritized. Why? It's due to its explosive growth trajectory and its unique characteristics. It has already exceeded $2 trillion in market capitalization, which is huge, but it's still described as rapidly growing into the asset that it's going to become.
So still evolving.
Exactly. It's not a finished product like gold, maybe.
Yeah.
It's still in the process of building significant network effects. Think of it like Facebook or other networks. In their early days, every new user makes the network more valuable for everyone else. And it's gaining adoption, corporate adoption, and to some degree even sovereign adoption from nation states. That's a big deal. The expert views Bitcoin using this really powerful analogy. It's like gold combined with a tech stock.
Gold combined with a tech stock. Okay, unpack that a bit.
Well, the analogy highlights its dual nature. Like gold, it possesses inherent scarcity and hard money properties, right? There will only ever be 21 million Bitcoin, period. That makes it a truly finite asset. But crucially, unlike gold, it also possesses the potential for exponential growth dynamics, the innovative potential, the rapid adoption curve that you typically associate with a cutting-edge technology company. This unique combination scarcity, plus the potential for substantial, still developing adoption and technological advancement, that's precisely why it's prioritized in the portfolio. Even though gold is far more established, it just offers a distinct growth profile that gold simply cannot match at this stage.
That gold combined with a tech stock analogy, yeah, that really paints a clear and compelling picture. It helps understand that dual nature perfectly. Okay, and finally, pillar 3, cash equivalents. This might sound pretty straightforward, maybe even boring, but in this unique economic environment, what's its specific purpose and what's the expert's view on traditional bonds and maybe the broader influence of this fiscal dominance idea on holding cash?
Yeah, cash equivalents. It's a smaller slice of the overall portfolio, but it serves a crucial strategic role. Its primary purpose isn't really to be a long-term investment itself, but rather to act as a dynamic buffer against market volatility. Think of it like an emergency fund within your investment portfolio. It allows for strategic rebalancing. It gives you the liquidity, the dry powder, to make opportunistic investments when market turbulence creates dips or attractive entry points for other assets, like those equities or hard monies we talked about. So it's really a tactical position.
Okay, so not just sitting there, but ready to be deployed.
Exactly. Now, regarding bonds, the expert is quite clear. They are decidedly not bullish on long-duration bonds. So bonds that mature way out in the future, like 10, 20, 30 years. The reasons cited are, 1, continued volatility, the prices can swing quite a bit, and 2, yields that are simply not very high when you factor in inflation and other potential opportunities. They just look less attractive compared to other asset classes right now. And what's particularly noteworthy here and really vital for you to grasp is the influence of fiscal dominance on the expert's perspective about holding cash.
Right, that term again, fiscal dominance.
Yeah. It essentially means that government spending and debt levels have become so massive that they overwhelmingly influence monetary policy and the economy, maybe more so than traditional interest rate changes by the Fed. Because of this backdrop, the expert tends to fade or, disagree with arguments for holding really heavy static cash positions for long periods.
Why fade holding cash? Isn't cash king sometimes?
Well, in this specific regime, the overall environment of aggressive government spending and expanding deficits means that, as the expert puts it, things tend to run hotter than a lot of bears expect. In essence, There's this persistent inflationary pressure kind of built into the system now because of the fiscal side. And that pressure can subtly but consistently erode the real purchasing power, the real value of static cash holdings over time. That makes it less appealing for long-term allocation beyond its tactical role as that crucial buffer for rebalancing.
Okay, so in this environment, cash is less of a long-term safe haven and more of a strategic pause button, ready to be pushed when opportunity knocks. That's a really important distinction. Let's shift gears slightly now to some major macro developments that could impact all these pillars we've just laid out. First up, the yield curve. It's been a really hot topic, hasn't it? In financial circles, we've heard some prominent economists like Richard Clarida forecasting continued steepening. What's the expert's view on its likely trajectory, and what are the specific implications for how you should think about your bond allocation, maybe differently than usual?
Yeah, the yield curves, that line showing the difference between short-term and long-term interest rates, it gets a lot of attention for good reason. The expert has a pretty nuanced view on it. For the next 6 months or so, they anticipate it will be flat to up. What that means is short-term and long-term rates will either remain relatively close together, or maybe long-term rates might rise slightly more than short-term ones. This outlook is primarily pinned on the ongoing economic deceleration we discussed earlier. A slowing economy can put some downward pressure on the longer end of the curve, keeping it relatively flat or just slightly up. However, looking further out, say 18 months or more, the base case fundamentally shifts. The expectation becomes a steeper yield curve.
Steeper meaning long-term rates significantly higher than short-term rates.
Exactly. And this steepening is anticipated to be driven by a potentially powerful combination of factors. One, likely lower short-end interest rates, which would probably be a result of potential Federal Reserve cuts eventually. And two, coupled with relatively flattish, longer duration rates. They don't see long rates crashing down necessarily. A key factor influencing this longer-term outlook is the expectation of a new Fed chair by that time, maybe around 2026. And the expectation is that person is likely to have a more dovish bent.
Dovish meaning?
Meaning a more accommodative stance, favoring lower interest rates perhaps compared to the current committee stance. Now, regarding bond allocation, this distinction is absolutely critical for you, the listener. The expert's preference remains for shorter durations. Specifically, bonds maturing in 2 to 5 years, rather than very long-term instruments. And here's a crucial warning, one that often goes against conventional wisdom. Fed rate cuts do not automatically guarantee lower long-end rates.
Say that again. Fed cuts don't mean lower long rates.
Right. Things like mortgage rates or yields on 10-year Treasury bonds might not fall just because the Fed cuts the overnight rate. In fact, if the market perceives the Fed as becoming too dovish, maybe losing its grip on inflation, it could paradoxically cause the long end of the curve to sell off, driving those long rates higher.
Wow.
So the expert still prefers the relative predictability of short-end fixed income when looking for stability, trying to avoid the unpredictable dynamics of the longer end of the curve. It's really a departure from that simple Fed cuts rates, all rates go down narrative we often hear.
That is a truly critical distinction, the idea that Fed cuts might not translate to lower mortgage rates. As you say, that's incredibly counterintuitive for many people. It forces us to rethink a fundamental assumption about how things work. Speaking of rates and their impact, what's the detailed outlook for the banking sector, particularly given that interest rates might not be coming down as rapidly or predictably as some hope, and we're in this overall malaise environment?
Well, reflecting that sort of range-bound view, the expert doesn't anticipate significant net interest margin expansion for banks.
Meaning their core profitability isn't expected to surge.
Exactly. The market generally sees them as priced for stagnation. This means investors aren't really expecting huge growth in their profitability coming from that traditional source. The difference between what they earn on loans and what they pay out on deposits. That's a crucial point for anyone investing in banks. The preference within the banking sector is quite specific, though. Regional and super-regional banks.
So not the giant money center banks, but the next tier down.
Generally, yes. These are the mid to large size banks, often serving specific geographic areas or specialized markets. The reason for this preference is their demonstrated resilience. These institutions have, by and large, successfully navigated some turbulent periods recently, especially dealing with those unrealized losses on their balance sheets we heard so much about.
Right, paper losses on their bond holdings.
Exactly. They've managed those portfolios effectively. And while some of the larger super-regionals maybe had to retain earnings and raise some capital during the more challenging periods last year, they are likely nearing the end of that phase. This could mean a potential shift back towards returning capital to shareholders, through dividends or share buybacks. That makes them potentially more attractive to investors looking for income. So the overall investment view for the banking and insurance sectors is framed as essentially a yield play with some growth attached.
Yield play, meaning income focused.
Primarily, yes. It suggests they offer a relatively steady income stream from dividends, along with maybe some potential for modest earnings and dividend growth over time. But, and this is important with the understanding that bank stocks typically come with higher volatility than, say, a bond. It's not about explosive growth here. It's more about consistent performance and income generation.
Okay, so for banks, it's more about finding that stable income stream rather than banking on a sudden explosion of growth. That certainly recalibrates expectations. Makes sense. Now, let's talk about something really innovative, maybe even potentially game-changing in the financial landscape. MicroStrategy's evolving strategy, they're now branding it as strategy.micro. They seem to be making a significant shift in their credit profile, moving beyond those traditional convertible bonds they were known for. What exactly is happening there, and why is this development considered potentially so significant for the broader finance sector?
Yeah, this development with MicroStrategy, now strategy.micro, it's truly fascinating. And in the experts' view, it's a potentially landmark shift in corporate finance, especially involving digital assets. Historically, yes, MicroStrategy was primarily known for issuing convertible bonds that's debt that can be converted into company stock under certain conditions. However, they're now introducing a new and quite distinct preferred offering. You can think of it like a hybrid financial instrument. This preferred stock is specifically designed to trade at a pegged level, almost akin to a stablecoin or a money market instrument in terms of its perceived price stability.
Yeah.
But here's the critical part.
Okay.
It offers a yield, an interest payment, that exceeds what you get on treasuries. So providing potentially a higher return than typical government bonds while aiming for price stability. The unique and really innovative aspect of this is how it's backed. It's directly collateralized by a large pool of Bitcoin held by the company.
Backed by Bitcoin. Interesting.
Very. This backing gives it a distinct security profile compared to traditional preferred stock. Furthermore, it offers immense flexibility for the company. It has adjustable coupons, meaning the interest payments can potentially be adapted based on conditions. And, importantly, it includes the ability for the company to suspend dividends if needed without triggering a catastrophic Bitcoin liquidation or a formal default scenario.
Ah, so a safety valve for the company.
Yep. Exactly. A crucial safety valve, especially given Bitcoin's volatility. The expert finds this a very interesting introduction to the finance sector because it essentially creates a novel model. It allows a company to hold a scarce, potentially appreciating asset like Bitcoin on its balance sheet, while simultaneously issuing debt-like instruments that are denominated in a potentially debasing fiat currency, currency that might lose purchasing power over time due to inflation or fiscal policies. It's seen as perhaps a blueprint for leveraging a strong, scarce digital asset base in a novel way to raise capital, and its issuance is expected to grow significantly. This could indeed influence how other companies think about leveraging their digital asset holdings and maybe redefine certain aspects of corporate finance in this emerging digital age.
That is a truly clever and innovative way to bridge traditional finance with the world of digital assets, specifically Bitcoin in this case.
Yeah.
Fascinating. Now, let's pivot from financial innovation back to global pensions. Geopolitical tensions, particularly unfortunately in the Middle East, seem to have been escalating again. What are the broader implications for investments, particularly equities? And how is the expert approaching, or maybe choosing not to approach, this very specific type of risk in their portfolio?
Right, geopolitics. The expert makes a very clear distinction here. They personally do not invest in defense stocks. They explicitly state that they leave that to specialists, acknowledging it's a very specific sector that requires deep, dedicated expertise, which is, frankly, outside their core focus area. Instead, their preferred approach to navigating geopolitical risks, particularly those that could impact energy markets, which is often the main transmission mechanism, is to invest directly in energy producers through equities.
So owning shares in oil and gas companies.
Exactly. Owning shares in companies that actually extract oil and gas. But their focus is on companies that meet very specific criteria. They look for companies that trade at low multiples, meaning their stock price is low relative to their earnings or cash flow. They need to be profitable, even at current, maybe moderate oil prices. They should be paying consistent dividends or actively buying back their own shares, returning cash to shareholders. And crucially, they need to maintain strong balance sheets, low debt. This strategy essentially serves as what the expert calls a perpetual option against Middle East destabilization or really any other major global events that could unexpectedly drive energy prices significantly higher.
A perpetual option. How so?
Well, if those risks materialize and energy prices spike, these stocks should benefit significantly. But in the meantime, while you're waiting, these investments are generating steady income through those dividends or buybacks. They provide a return even if those geopolitical risks don't escalate into a full-blown energy crisis. You get paid to wait, essentially. The current dynamics of U.S. shale oil production also play into this thinking. U.S. shale, which has been a major source of global supply growth in recent years, is now seen as gradually stagnating. There's just not a lot of drilling activity compared to before. Why? Because current oil prices aren't quite high enough to sufficiently encourage massive new investment, especially given that the depletion rates for shale wells are quite fast. They decline quickly. So given this slowing U.S. shale growth, combined with the potential for future Fed interest rate cuts that could stimulate global demand, the expert suggests they could see higher energy prices ahead, even without a major geopolitical shock. Therefore, maintaining a dedicated slash of energy producers in the portfolio acts as a strategic income-generating hedge against unexpected crises, or is just a general rise in energy costs without having to become an expert geopolitical forecaster.
Okay, so it's about owning the underlying income-generating assets that stand to benefit from higher energy prices for whatever reason, rather than directly betting on conflict or specific political outcomes. That sounds like a very pragmatic approach. And that leads us perfectly into another massive structural shift with significant energy implications, the rise of AI. Specifically, its incredible hunger for energy. We hear projections, like from Bloomberg, talking about double-digit energy growth over the next decade, specifically from data centers powering AI. What are the tangible investment implications of this, and how does it compare to, say, the energy consumption of Bitcoin mining, which has often been in the spotlight for its energy use?
This is a critical point, and yeah, as you said, it often gets overlooked in the broader excitement around AI's capabilities. The expert makes a really crucial distinction here for investment purposes. They separate data center AI, that's the massive computational infrastructure, the server farms, from portable AI, which refers more to things like robots or localized AI devices you might have in your home or car someday. The surge in data center energy demand, as projected by Bloomberg and others, is creating immense structural demand for fundamental electrical components. We're talking about things like converters, transformers, high-voltage transmission equipment, the basic building blocks of the grid. Companies producing these items often have backlogs extending out 3 to 5 years already. And a significant portion of these parts, interestingly, are sourced from places like China.
Adding another wrinkle.
Exactly. Which further complicates supply chains and puts significant strain on existing electrical grids worldwide. This isn't just about needing more power. It's about needing a fundamental reshaping and upgrading of our energy infrastructure to handle it. Now, to put the sheer scale of this energy demand into perspective, the expert uses this really striking analogy comparing AI computation to the human brain. They highlight roughly a million-fold difference in power efficiency. Our human brain, this marvel of biological computation, runs on about 20 watts. That's less power than an old-fashioned incandescent light bulb. In stark contrast, the best supercomputers today, attempting to perform calculations estimated to be somewhere in the ballpark of the brain's capacity, consume around 20 megawatts.
20 watts versus 20 megawatts. That's staggering.
It's a mind-boggling difference, a millionfold. This vast gap makes the prospect of portable AI truly matching human capabilities, especially in terms of power efficiency, seem far away right now. It really underscores the current immense energy cost of advanced AI computation. Now, when comparing this to Bitcoin mining, a significant and often misunderstood difference emerges. While Bitcoin mining has certainly faced considerable criticism for its energy use, the expert points out that AI data centers actually can compete with consumer electricity prices and therefore have the potential to drive up electricity prices for everyone in ways that Bitcoin miners largely do not.
Why is that? Why the difference?
Well, Bitcoin miners are, by nature, super competitive on energy costs. They actively seek out stranded energy, that's surplus energy in remote locations, maybe, that might otherwise go unused. Or they strategically buy energy at off-peak times when demand and prices are lower. And crucially, they have operational flexibility. They can, and often do, shut off their operations when electricity prices spike. They are price-sensitive energy buyers of last resort in many ways. AI data centers, however, operate under very different constraints. They demand extremely high uptime they need to be running constantly.
They need lower latency, meaning faster response times, which often requires them to be located closer to population centers where the data is being used. This makes AI data centers a much more direct competitor for the same electricity that powers our homes and businesses. And that leads to a much stronger potential to drive up overall electricity prices for everyone in those regions.
Okay, that's a really eye-opening comparison, especially that direct impact on consumer electricity prices from AI versus the flexibility of Bitcoin mining. It highlights very different market dynamics.
Exactly. So given this dynamic, the experts' resulting investment play is to be long natural gas, specifically targeting producers that also yield oil, recognizing that natural gas is a primary fuel for electricity generation, especially flexible generation needed to back up intermittent renewables. They also advocate directly holding physical uranium, which fuels nuclear power, another key source of baseload electricity. Interestingly, they are less keen on uranium mining stocks, given the specific challenges and historical volatility often associated with that particular sector. So, holding the commodity itself, this is really a direct bet on the foundational energy sources that will be needed to power this AI revolution.
Fascinating. A direct play on the energy inputs. Sticking with economic headwinds for a moment, let's talk about tariffs. It feels like the market is surprisingly complacent right now. Current tariff rates are apparently similar to levels back in April when markets definitely reacted negatively. What's going on here? Is the market just ignoring it? And what's the experts' assessment of the real underlying impact of these tariffs on the economy and ultimately on us as consumers?
It's true, there's a noticeable disconnect there. Despite current tariff rates being quite high, comparable to levels in April that, caused significant market jitters, current stock markets are actually hovering near all-time highs with seemingly little concern priced in. The expert interprets this as indicating there's likely more risk from tariffs than is probably being priced in by the market currently. The data seems to suggest that import prices aren't really coming down significantly. Meaning it implies that foreign exporters are not absorbing the cost of these tariffs by layering their prices. Which means, simply put, that most of the tariff revenue is coming from some combination of American consumers and American businesses. Essentially, we're the ones paying for them, either through higher prices at the checkout or lower profit margins for businesses, which can eventually impact jobs and investment. Now, there was a temporary buffer created back in Q1 because importers apparently front-ran the tariff.
Front-ran. They bought early.
Yeah, they anticipated the tariffs coming and pulled in extra goods before the new rates fully went into effect. Stocked up, essentially. So the reported $150 billion or so in annual tariff revenue hasn't fully trickled down into consumer prices or business costs just yet. However, the expert warns it will increasingly trickle out into the economy in the coming months as that buffer inventory gets used up. These tariffs represent a kind of mild drag on the U.S. economy. It's like they're partially offsetting the stimulus effect that comes from those large structural fiscal deficits we talked about earlier, almost like applying a gentle brake while the accelerators still press down hard from the government spending side.
Interesting analogy. A brake and an accelerator at the same time.
Kind of. And the impact is also quite uneven, which is key to understand. Tariffs disproportionately affect tariff-heavy sectors. Think about the auto industry, for example, like Ford, which relies on complex global supply chains. They feel it much more directly. In contrast, companies like, say, Microsoft, which is maybe 100 times larger by market cap but doesn't employ anywhere near twice as many people as Ford, they are far less concerned because their business models are less exposed to import duties on physical goods. This differential impact tends to trickle out quarter by quarter into what the expert describes again as those stagnant economic conditions. Not necessarily a crash, but a drag. So the expert is currently in the camp that views a gradually decelerating U.S. economic situation. And based on this, they're advising potential caution for you, the investor, over the next couple of months, maybe until more clarity emerges on the tariff situation and its real impact. This caution is amplified by typical stock market seasonality, which historically isn't always favorable, particularly in months like September.
Right. Sell in May and go away. Sometimes there's truth to that.
Sometimes. And looking at the GDP nuances reinforces this caution. Q1 GDP was negatively impacted by that import front-running we mentioned, making growth look weaker than it was underneath, while Q2 GDP then benefited from the hangover effect, as those pre-tariff imports were used up, making growth look artificially stronger. However, what's concerning, and maybe a better gauge of underlying health, is that final domestic sales, a key measure of real underlying economic demand from consumers and businesses here, were markedly decelerating in Q2. That's not a great sign. Moreover, CEO confidence surveys are down. That's typically a negative signal for future capital expenditures by businesses and for hiring decisions. So overall, the assessment is, there are definitely yellow flags waving, but maybe no massive red flags signaling an imminent collapse just yet. However, concerns are increasing about a broader deceleration setting in once that temporary buffer from the front running and the inventory accumulation fully wears off. It points towards a slow, persistent drag rather than a sudden shock.
Okay, so we're talking about more of a slow burn of economic friction, a gradual slowdown, rather than an immediate headline-grabbing crisis from these tariffs. That nuanced view is helpful. This detailed analysis, though, leads us perfectly back to that powerful, almost alarming statement we started this whole deep dive with: nothing stops this train now. Our expert frequently references a truly fascinating and, yeah, somewhat unsettling chart. It depicts the fiscal deficit as a percentage of GDP plotted against the unemployment rate. And they look like an alligator jaw that's snapped wide open in a way that is utterly unprecedented in modern history. What does this striking and frankly kind of scary visual imply for the long-term health of our economy and for your financial future?
Yeah, that alligator jaw chart, it's not an exaggeration to say it's a visual representation of an unprecedented break between two crucial economic data sets that historically moved much more closely together. Historically, when unemployment was low, like it is today, closer to 4%, governments would typically see their fiscal deficits shrink.
Right, because more people working means more tax revenue, less spending on benefits.
Exactly. More people paying taxes, needing fewer social safety nets, leads to increased government revenue and reduced spending. That was the normal pattern. But here we have this bizarre and, unprecedented situation where the fiscal deficit is blowing out to nearly 7% of GDP, a huge number usually only seen in deep recessions, while unemployment remains remarkably low. It's as if two perfectly synchronized dancers who always move together have suddenly started moving in completely opposite directions. And that wide gap between the lines on the chart, that's the alligator jaw effect. It's not just a minor anomaly. It represents a fundamental, really never before seen disconnect in how our economy is currently functioning. And what's particularly alarming, or at least concerning, is the experts' belief that this alligator jaw won't snap back easily on its own. If it does close somewhat, the thinking is it's more likely to be due to even higher employment somehow, rather than a narrowing deficit driven by a sudden magical reduction in government spending or some explosion in tax revenue. The structural forces are pushing the jaws apart.
What are the structural forces keeping the jaws open?
Well, there are two main underlying drivers for this phenomenon, and they are fundamental and deeply structural. First, demographics. Simple as that. We have an aging population in the U.S. and many developed countries. That means, straightforwardly, more people drawing from Social Security and Medicare than paying into it. This creates an inherent, built-in, increasing pressure on government spending, and thus contributes to larger deficits, even when the economy is otherwise strong and unemployment is low. That pressure just keeps growing. Second, and this is huge, we've reached the end of a remarkable 40-year period of generally declining interest rates. For 4 decades, falling rates acted as this crucial offset. Even as government debt-to-GDP ratios steadily climbed higher and higher, the interest expense on that debt remained surprisingly manageable because borrowing costs kept going down. Now, with rates seemingly in a choppy range and unlikely, in the experts' view, to return to those historic ultra-lows anytime soon, that crucial offset mechanism is gone. So the combination of higher interest expense on a massive existing debt load plus more seniors drawing benefits, it creates significantly more structural strain on fiscal deficits. This scenario, where the jaws are unlikely to close on their own due to these deep-seated forces, is precisely what the expert calls fiscal dominance in a nutshell. It signals a profound and likely persistent shift in the economic landscape, altering how everything else operates around it.
Wow. That alligator jaw metaphor really emphasizes the severity and the truly unique nature of this unprecedented divergence. It's not just a blip. So you've mentioned fiscal dominance several times now and explained it's basically the fiscal situation driving things. For our listeners, can we just crystallize that? What exactly is fiscal dominance and why is it considered such a persistent, maybe even game-changing shift in the economic environment? How does it fundamentally alter how even monetary policy works?
Yeah, absolutely. It's a crucial concept to grasp, because fiscal dominance is arguably the new lens through which we must understand the economy going forward. In the past, let's say pre-2008 or even earlier, when public debt levels were relatively lower as a percentage of the economy, the primary way the central bank, the Fed in the U.S., would slow the economy down by raising interest rates was fairly straightforward. It worked mainly by making it more expensive for banks to lend money.
Higher rates meant banks borrowed at higher costs, so they charged more for loans, which slowed down credit creation, cooled off business investment and consumer spending, and ideally curbed inflation. That was the textbook mechanism. But now the dynamic has fundamentally changed, with public debt exceeding 100% of GDP, meaning the government owes more than the entire annual economic output of the country, and a significant portion of recent inflation arguably stemming from monetized fiscal deficits. Essentially, the government spending money that the central bank helps create or facilitate. The traditional tools just don't work the same way anymore. When the Fed raises interest rates in this environment, it actually blows out the fiscal deficit by a bigger number than it slows down bank lending.
How does raising rates blow out the deficit?
Because the government have to pay interest on its massive debt. A higher interest rate applied to over $34 trillion in debt means significantly higher interest payments flowing from the Treasury. This directly increases government spending and widens the deficit. The consequence is that high interest rates don't really do what they used to do in terms of slowing things down across the board as effectively. In fact, by significantly increasing the government's interest payments, they can sometimes perversely add fuel to the fire of the deficit and potentially even inflation by injecting more money into bondholder pockets. This is what makes it a more persistent regime. It's not just a temporary state. For instance, that historic negative correlation between gold and real interest rates, where gold usually performs well when real interest rates minus inflation, are low or negative, has effectively decoupled in recent years.
Why is it decoupled?
Because fiscal factors, the sheer scale of government spending, the debt dynamics, the deficit itself, now arguably outweigh the traditional influence of interest rate dynamics on assets like gold. The central bank's actions are increasingly constrained, or at least heavily influenced, by the government's massive fiscal position. They can't just raise rates indefinitely to crush inflation without potentially causing a significant fiscal problem or even a crisis. It's a world where the government's spending habits and borrowing needs are dictating more of the economic reality than the central bank's rate decisions alone.
That truly redefines how monetary policy functions and highlights its limitations in this new environment. It really is like the fiscal tail is now wagging the monetary dog.
Okay, so given this new era of fiscal dominance, given this unstoppable fiscal train, as the quote put it, what assets are best positioned to not just survive, but potentially truly thrive in this landscape? What should listeners be looking for specifically? Right. In this kind of environment, the core theme for resilience and potential growth really revolves around anything possessing a degree of scarcity. First, Bitcoin is highlighted explicitly by the expert. They call it one of the fastest horses available at scale with liquidity.
Fastest horse, meaning high growth potential.
It's exactly. High growth potential, but also an asset that you can easily buy and sell in large quantities, unlike maybe some other niche assets. They maintain a structural bull view on Bitcoin, meaning they believe its underlying fundamentals, its scarcity, its network effect, its potential as a global neutral money will continue to drive its value higher over the long term, especially relative to inflating fiat currencies. Its inherent, programmable scarcity and its growing network effect make it a potential strong beneficiary in a world of seemingly endless government debt creation. Gold is also seen as a clear beneficiary of fiscal dominance. Particularly, the framing is often gold over bonds. As governments rack up debt and potentially inflate away its real value over time, gold, with its millennia-long history, acts as a fundamental hedge against that currency debasement and those rising government liabilities. Beyond these literal hard assets, though, certain types of equities can also benefit, specifically equities at reasonable prices. Think about it. Companies that were smart or lucky enough to lock in low-rate debt issuing bonds for 5, 10, 20, or even 30 years back when rates were near zero are essentially seeing their liabilities inflated away over time as the real value of the money they owe decreases. That helps their balance sheet. And critically, those businesses that possess genuine pricing power, the ability to raise their prices to customers without losing significant business, they can potentially keep ratcheting up their prices, maintaining or even growing their profitability in nominal terms, even as inflation rises.
So, companies that can pass on costs.
Precisely. And companies like Strategy.micro, which we discussed earlier, they kind of exemplify this strategy perfectly in a novel way. They hold a scarce asset like Bitcoin, which they expect to appreciate, while simultaneously issuing credit instruments denominated in a potentially debasing currency, the US dollar. As long as they manage their operations and leverage conservatively, they potentially benefit from this structural arbitrage between a hard asset and fiat liabilities. So the core theme really is anything with a degree of scarcity, whether that's an economic moat for a business, a sustainable competitive advantage that protects its profits and pricing power, or whether it's literal scarcity like gold or Bitcoin. These types of assets and business models are generally seen as well-positioned for fiscal dominance. They offer both a defense against currency debasement and potentially an offense for capturing growth in a world where traditional financial anchors are clearly shifting.
It truly sounds like scarcity in all its forms, whether it's inherent to the asset itself or carefully built into a business model through competitive advantages, is the ultimate hedge and maybe even the key to flourishing in this new economic regime. That's a really powerful takeaway. Now, thinking about the other side of the equation, monetary policy. Let's talk about the Federal Reserve's next chapter. There's always speculation, isn't there, about who might eventually replace the current Fed chair, Jerome Powell, and what that could mean for the future path of interest rates. What's the experts' expectation regarding future Fed leadership and the broader interest rate landscape going forward?
Right, the Fed leadership question always looms. While the expert wisely avoids speculating on specific names for who might be the next Fed chair, a crucial expectation they hold is for a more dovish, more accommodative appointment. Probably by 2026, when the current chair's term is up for renewal or replacement.
Dovish again meaning leaning towards lower rates.
Generally, yes. More accommodative. Meaning whoever is appointed is likely to favor policies that lean towards lower interest rates and perhaps a more supportive stance for economic growth, maybe putting less emphasis on inflation fighting compared to the current committee. And this shift would likely lead to lower average interest rates by that time, compared to where we are now or where we've been recently. It's important to clarify, though, something the expert always emphasizes. The Fed chair is not a unilateral decision maker. Monetary policy is set by the Federal Open Market Committee, FOMC, so it's a collective decision, influenced by the chair but not solely determined by them. Looking at the broader rate landscape based on this outlook, the forecast is generally for mildly lower short-term interest rates over the next year or two. This is where you might see some relief eventually on things like credit card rates or adjustable rate loans tied to the short end. However, and this echoes our earlier discussion, the expert anticipates flat and choppy longer-end rates.
This means rates on things like 10-year Treasury bonds or 30-year mortgages might not move down much, or could even be quite volatile, without a clear, sustained downward trend, even if the Fed cuts short-term rates. And here's that critical point again, a vital clarification for you, the listener, because it goes against common assumptions. Just because the Fed cuts rates doesn't necessarily mean that, say, mortgage rates go down or long-end Treasury rates go down.
Still find that counterintuitive, but okay, hammering it home.
It's so important in this environment. The yield curve, that line representing different interest rates for different durations, could in fact steepen simply by short-term rates falling while long-term rates remain roughly where they are, or even nudge slightly higher if inflation fears persist, or the market questions the Fed's resolve due to fiscal pressures. This really challenges that deeply ingrained belief that Fed rate cuts automatically translate to broadly lower borrowing costs across the entire economy, especially for long-term loans like mortgages. The connection is far more nuanced now, largely because of that fiscal dominance backdrop we keep coming back to.
That is such a crucial point for anyone thinking about refinancing their home or maybe trying to time the housing market. It completely upends what many of us have come to expect from Fed actions based on past cycles. And that brings us directly then to the consumer and the housing market. If, as you've clearly explained, mortgage rates aren't necessarily going to plummet back to 3% just because the Fed might cut short-term rates, what does that imply for a potential housing refinance cycle? And what kind of overall pressure might the average consumer face in this kind of environment?
You're absolutely right to connect those dots directly. Unlike past rate-cutting cycles, think back to after the 2008 crisis or during the pandemic where falling interest rates often triggered a massive housing refinance cycle, allowing millions of homeowners to lower their monthly mortgage payments and freeing up significant disposable income that then boosted the economy. The expert does not expect a really big housing refinance cycle this time around. The primary reason, as we've just hammered home, is that mortgage rates are simply unlikely to reach a lower low, meaning significantly lower than prevailing rates today that would incentivize a truly widespread wave of refinancing activity. We're just not expecting to see 3% or maybe even 4% mortgage rates again anytime soon, if ever, given this new fiscal reality and potentially stickier inflation. This largely limits any significant refinancing volumes primarily to those homeowners who perhaps locked in much higher rates right at the peak in 2022 or 2023. They might see some modest relief by refinancing down to today's rates, but it won't be that broad-based economy-stimulating phenomenon we saw in the past.
This resulting much smaller burst of refinancing activity combined with the ongoing subtle impact of those tariffs that are gradually trickling down to consumers in the form of higher prices for imported goods. Well, the combination will put some pressure on the consumer. They likely won't get that significant boost to their disposable income that homeowners often received in previous rate-cutting cycles from refinancing. This limited consumer uplift, particularly from the housing market wealth effect, is another significant factor contributing to the overall expectation of that range-bound period in terms of economic performance and maybe top-line equity performance for the broad market. It strongly reiterates that malaise outlook we discussed right at the very beginning of our deep dive today. The consumer will likely feel a persistent, low-level squeeze rather than enjoying a major boom fueled by falling borrowing costs.
Okay, so tying it all together, if, as the expert powerfully states, nothing stops this train of fiscal deficits, and if scarcity, in all its various forms, is truly the key to navigating this new economic regime, what profound implications does that have for your long-term planning? Thinking beyond just the specific assets you choose to hold in your portfolio, what does this kind of seismic shift mean for the very nature of economic value, for the definition of wealth itself, in the years and perhaps even decades to come? It feels like a really big question.
It is a big question, and it raises an incredibly important and frankly fundamental point for all of us to consider. In an environment where the traditional anchors we've relied upon, things like stable interest rates, predictable government debt dynamics, maybe even the unwavering long-term purchasing power of our fiat currency, where these anchors are fundamentally shifting or becoming less reliable. Understanding the true drivers of value, and perhaps more importantly, long-term wealth preservation, becomes absolutely paramount. It's about recognizing that the underlying rules of the economic game seem to have fundamentally changed, or are in the process of changing quite dramatically. This requires potentially a new approach, a new way of looking at how we view money itself, how we think about debt, both holding it and issuing it, and ultimately what we believe genuinely retains its worth in a world increasingly shaped and influenced by these powerful structural fiscal realities. It asks you, the listener, to look beyond the immediate headlines, beyond the short-term market fluctuations, and really consider what fundamental value truly means when the very fabric of our financial system might be undergoing such a significant long-term transformation. It's a call, perhaps, to rethink some long-held assumptions about where real, durable value resides in the 21st century.
That is a truly profound thought to end on. Rethinking where value resides. Wow, this was an incredibly dense yet powerfully insightful deep dive. You've truly broadened our understanding of this complex dynamics today and really given us a lot to think about. For that, we are incredibly grateful. Thank you.
Oh, it's always a pleasure to be here, and thank you for creating the space and taking the time for us to really explore these crucial topics in such necessary detail. These things aren't simple, so the time is appreciated.
Absolutely. Now, for everyone listening, if you want to delve even deeper into our experts' extraordinary work, and I highly recommend you do, you can find much more at lynalden.com. That's LYNALDEN.com. And we also highly recommend checking out their insightful book, Broken Money. It's available on Amazon and pretty much everywhere else books are sold. It really ties a lot of these historical and current themes together. We'll also do our best to keep you updated on the fascinating progress of Ego Death Capital as well. As always, we sincerely hope this deep dive has given you a real shortcut to being well-informed, providing maybe some of those aha moments without the usual information overload. If you found value in this deep dive today, please take just a moment to follow, like, and maybe share it with others, friends, family, colleagues who are also looking to understand the complex world of finance and economics. It really helps get these insights out there. And of course, for continuous insights and updates between our deep dives, you can always follow What Bitcoin Taught Me. We're on Twitter, X, Nostr, Bluesky, Threads, Instagram, and Facebook, as well as LinkedIn, pretty much everywhere. Until our next deep dive, stay curious, keep asking questions, and stay informed.